Hi everyone, welcome back to Be Rich. It's been an interesting week to say the least, and it's very hard to focus on what to do in terms of investing. When you see the markets, the way they're reacting or not reacting, and being desensitized to all the news, and then you hear more and more kind of like geopolitical theatrics, like I was talking about yesterday. Then it came out that Trump was really angry with both Israel and Iran, and he's saying F this and F that. And Israel seems to be in no mood to listening to Trump anymore. And then it comes out the so-called thing that destroyed the Iranian nuclear program really did not do so much damage after all. I don't know. This whole thing, I guess that's why the markets kind of have the inside scoop and they seem to be not reacting because they seem to be in the know. At least that's what I can say jokingly. So yesterday I spoke about gap and non-gap. A lot of you asked where you get gap and non-gap information. Do a little bit of work, man. Go Google. Go deep dive a little bit. I gave you a little bit of a teaser. Then I expect you to sit there and get inspired and go read about it and dive into it and, find a little bit of information. If I give you all the information and I do everything, then next if I show you where the gap reports are, then you'll ask me, okay, now for this company, why didn't you tell me this gap report is good or not? And then what's the point? I'm here to help you learn, not to tell you the answers, because there are no answers. And that is what brings me to the topic today. Because today I want to talk about this article I read about one of my favorite thinkers about investing, a person who I deeply admire his intellectual views about value investing especially. And he's written many books and he's a professor in Stern College in the US. And he's got a new book out also, which I'm still getting through. But this article which he had written about was really fascinating. It's about contrarian investing. Value investors are known as contrarian investors. Not all. So his articles about this, and I'm talking about Ashwath Damodaran, of course. He has got a very grounded voice, and he understands how investor behaviors are, and it's a great way to understand psychology of investors and how to guard ourselves. So his latest piece was about that, and he talks about that being an investor is not about bravado, it's all about psychology and the way we think. So let's dive into this article which I read, and he basically classifies into 4 types of contrarian investors. He outlines them, and let's see where you and I fit in this. Right? The first one is known as a knee-jerk contrarianism. What is knee-jerk contrarianism? First up, this is the most dangerous type of contrarian investing, knee-jerk reaction, as they call it. Because if you see a red ticker, that means it's on sale. You don't even bother doing anything. Examples would be like Yes Bank in 2019, Bath and Beyond in the US in 2020. Prices were dropping, everyone was screaming deep value, and a lot of people bought into it. But here's the thing, just because a stock is falling, it doesn't mean it will rise again. There's a myth in investing known as the mean to revision. If something goes down, if something is an average. I've spoken about this in terms of the Nifty index, the Sensex. If we say the average is 20 PE, and if it's above 20, it has to spend equal time below for it to be. That is a broad market you're looking at. But when you look at an individual stock, mean to reversion may not happen. And he points out that, while buying low and selling high sounds great, it still has to be grounded on buying in fundamentally sound companies. And he quotes this famous thing by DeBond and Taylor, study done in 1985, which shows losing stocks will outperform winning stocks over the long run. But in the short term, momentum dominates. That he quotes another research by Jagdish and Titman, and that shows that winners keep winning and losers keep losing in the short term because momentum is there. But at the same time, he does say it's like catching a falling knife. With individual stocks, especially dangerous ones like Yes Bank, you need to understand it's just not market mood. Because it fell because it was broken fundamentally. The stock, the company, the bank was broken fundamentally. The same is true with Jet Airways. The same was true with Future Retail. You need to understand why it's falling. Just because something is falling, you can't just assume it's going to bounce back, right? Maybe it's falling because it's burst into flames. Like Icarus flew too close to the sun. and the wax started melting and the feathers fell off and he saw his son fall. So it could be that. So that is the important thing when knee-jerk contrarian investor. That's why I said it's the most dangerous one, because you're not paying attention to what is happening. You're having so much of FOMO that when you see it, the price correcting, you just immediately run into it. A lot of you suffered this with IndusInd Bank also recently. Anyway, keep that in mind. This is true for all markets, American and Indian. The next one is known as technical contrarianism. Okay, what is technical contrarianism? You just don't look at the thing turning red. You look for signs. You read charts. Okay, watching the RSI, the so-called Bollinger Bands. Okay, think of a trader looking at Reliance Industry dropping 10%. Then they waited to hit for the 200-day moving average. Then they look for the bullish divergence in the RSI. Then they buy. He says these tools can show you in the short term how the mood is swinging in the market, right? Technical patterns like double bottoms, head and shoulder reversals. These are very nice. Volume spikes. They can often indicate the market sentiment. But here's the catch. Not everyone agrees that signal matters. Even if you get it right, it's often marginal what he's talking about, where you get it right. And technical trading demands speed, discipline, and emotional detachment, which none of us have. We don't have the discipline, nor do we have the emotional detachment. We don't have that kind of temperament to do this. So this is the main reason I don't touch trading. I don't do future options, because that kind of mindset, it's not in me. And it's not in most of us. We are all not disciplined, nor are we emotionally detached. So the transition costs, the slippages, the tax that enters into the picture, especially when you look at in India, the STT, short-term capital gains, and can really hurt you. And you don't realize all that effort you put won't make sense finally. So it's useful for maybe for seasonal traders. But if you're looking at it for a long-term strategy as an investor, value investor, deep investing, it doesn't really prove to be useful. Now, let's get into the third one. This is getting closer to my zone. This is known as constrained contrarianism. Okay, what is constrained contrarianism? It's like where most of us value investors live, like you and me. We just don't buy it because it's cheap. We put it through our filters, through the quality filters, and we find our list of stocks which are good quality. And when the price becomes cheap, we buy. So we have simple criteria like, PE being below 15, dividend yield being over 1%, net debt over EBITDA being less than 2. So basically cheap, giving you cash and not drowning in debt. That's our philosophy. If you listen to Anand, a lot of you keep asking Anand, how do you go about investing? How do you pick these companies? It's as cheap as that. The company is cheap. It's spewing cash, as Anand says, and there's no debt. Anand doesn't say drowning in debt. Anand says your debt should not be there at all. So you can apply it to something like Hindustan Zinc in 2023. It fell sharply due to dividend cut. It had low debt, strong asset, and the PE ratio was below 10, so it passed the filter. Other hand, you look at Vodafone. Okay, I'm not asking you to go buy these companies right now. I'm just talking them about as academic examples in the past. That's why I'm taking things in 2023, 2020, 2019, way back. So don't get confused and say, Vinod, are you talking about these stocks now? No, I'm not talking about these stocks now. I just want to teach you a lesson, like I said in the onset. I'm here to give you some crumbs and then you should do some work yourself, because I want you to learn. So Vodafone was also cheap, but would you buy it? High debt, no profit, visibility, constant dilution. That is a classic value trap. In the US, if you look, think of Intel in 2022. It looked cheap, but the competition from AMD and Apple's M series chip, the story was structurally broken, at least in the near term. So this style of investing is safer, may not give explosive returns, but it protects you from landmines. And that is exactly what we're doing. And we have taken it a step further with different coffee range. So not only are we trying to protect ourselves from landmines, we're taking small steps to make sure that we don't hit a landmine. Because our capitals are very small. We worked very hard to raise this capital, right? We are not people who are doing this for bread and butter, doing this to make a living out of it, like traders. Nor are we like Warren Buffett's with huge capital reserves so we can take a gamble. We are very small. We're in the middle class. We worked very hard, studied in college, managed sure we were disciplined, got rid of our debt and, bought the gold and got here. Now we don't want to take our money and lose it. So that's our mentality. So this is why I said, so the returns may not be amazing annually, but it's risk adjusted, so it works very well. That's what Damodaran says, and I agree with him. But there are warnings in this. Even your filters cannot detect. Like something like Kodak could have passed this filter very easily in the 1990s. Then the smartphone happened. So this strategy is not a shortcut. It is just a shield. It reduces your risk but doesn't eliminate it. This is why it's important that you keep, reading the news. Like Anand says, you must read the news, find out what is happening in your company, what is happening in your sector, what is the macro trend, where is the world moving towards. Like I did a video about alcohol industry. Should you be diving and buying into it because it's cheap, or is it a Kodak moment for alcohol companies? That I leave to you to analyze. I've put my views up there on that video. See it. Then I would love your thoughts on it too. Is it a Kodak movement for all these alcohol companies, or is it something that's going to recover? But anyway, section 4, opportunistic contrarianism. This is one of my favorites too, and Damodaran likes this one too, because opportunistic contrarianism isn't reactive, it's deliberate and it's patient, right? You don't react to the market, you don't care about what the market is doing. You take deliberate steps and action, and you're very patient in your investments. So you build a wish list of great companies, Anand's very good at this, that are too expensive, and you wait. When the market panics, you swoop in. This is what holding on to cash and war chest and all that. Like Warren Buffett sitting with $3 billion in short treasury bills. Sitting on a lot of cash. Of course, this works if you have, like Anand, you have a capital, you've invested, you have a war chest, you've done all the work, you've done the first bit. But it doesn't apply to all of us. If we have just started investing, you cannot build a war chest. A lot of you immediately will ask, but Vinod, I got a bonus, 2-3 lakhs, I'm ready to put it into the market. Why can't I put it all into the market when the market corrects? Because like that goes to the first one. We are beginners. We do not know. It's like trying to catch a falling knife. So that's why I say keep it in bonds, take the interest, invest, build your base. You're all very young. And a guy who's at 50 is saying build a base. That means you have enough time. If you're at the age of 25, like I was talking to a pilot yesterday on Instagram, the guy is ready to invest 2 lakhs every month for 25 years. He's like, I'm long term. I'm like, dude, yeah. But if you put 2 lakhs in bonds every year, that's 24 lakhs, right? In 25 years, you'd be sitting almost at 6-7 crores. You're taking the interest and invested in equity market. You have enough bandwidth to build slow and stable and secure. Your kids may be able to do this, keep a war chest, because every month from the 6 crores and everything else, cash will be spewing at that point of time. There'll probably be 10-20 crores. They can be like Buffett style. So keep that in mind. So in India, for example, you might have Titan, you might have Trent in your wish list, but you can't buy it because it's not in fair value. So you wait. You sit and you wait for that time when the market moves, and then when the market decides to drop it. This happened with Infosys many times. When there was a change of management, then there was a fear of some malfeasance and this and that. The stock kept dropping and people moved in those opportunities. It happened with Indian hotels. Anand famously said during the Mumbai attacks, what happened to the stock? So this periodically happens in companies. So we can't say it will never happen, but when it happens, you have to be ready and you have to keep the cash ready. So there's 2 parts of that discipline: keeping the cash ready and waiting for this. I don't recommend it for people who are starting investing, but if you have already built a volume of investment and you have all this, then of course you can sit and wait. There is no rush because you have the capacity to wait. Not all of us, especially the most of us who are viewing this video and this channel, who are following me on Instagram, are in this position. So I won't recommend this for this, but if you have reached levels of where Anand is, definitely this is something you can do. So I'd like to know, what kind of investor are you? Are you the first, the second, the third, the fourth? Are you a contrarian? Are you an opportunistic? Have you reached that level? So I'm curious to know. But he does say very nicely in the article that not strategy works. It's not a strategy that works finally. It is about your temperament. So can you resist the noise when everybody is selling? Can you hold on to it for 6 months even if it is in red and you're still able to sleep? Can you wait for 3-4 years without bailing it? Those are the real tests of value investing. That when everybody is selling, you're able to filter that noise out and keep buying. Okay, even if it's in red for 6 months or more, you're still able to sleep very soundly. And then you're waiting 3 to 5 years before you take any kind of action on it. Are you ready to wait? So this kind of mindset is something that you have to learn to develop, and it takes time. And that's what he goes on emphasizing in that article. So I'd like to know what your thoughts are. So do let me know, which kind of investor are you? Contrarian type, value investing, what you really fall into. And nothing more else to say. And I hope you had a wonderful day as always. And I hope you had a wonderful evening if you're here in India and in Chennai. Nothing else more to say. Catch you tomorrow. Of course, on Instagram Reels, I am talking about Tata Capital IPO and what is happening with the Tata Capital IPO. You can definitely catch me on Instagram and get my views on that. I'll even talk about the HTB IPO, all of you have been asking me about. So there also I have some views, I've taken some notes. I will put up both reels today on Instagram and you can catch it there. Thanks for watching the video as always. Tomorrow I'll try and dive into some stock. There's really been no stock news to talk about in company wise right now in the US. That is why I've not hit any company per se. And I'm waiting to see what the market does. A lot of investors are waiting and watching to see what happens. Anyway, wish you a wonderful evening. See you tomorrow.